F. Evaluate current market conditions, including credit availability, spreads, interest rates, terms, risk, as they relate to long-term borrowing strategies. Evaluating current market conditions is a critical Treasury responsibility because long-term borrowing decisions significantly affect an organization's liquidity, capital structure, profitability, and financial flexibility. Treasury professionals continuously monitor economic trends, capital market activity, inflation expectations, and monetary policy developments to determine the most favorable timing and structure for long-term financing. Borrowing strategies must align with organizational funding needs, risk tolerance, and strategic objectives while balancing cost efficiency and financial stability. Treasury teams analyze debt market conditions, investor demand, and banking sector liquidity before issuing long-term debt or refinancing existing obligations. Effective market evaluation helps organizations secure financing at competitive costs while minimizing exposure to unfavorable economic conditions, refinancing pressures, or liquidity disruptions in volatile financial markets. Credit availability is one of the most important factors influencing long-term borrowing strategies because access to financing can change significantly based on economic conditions and lender confidence. During strong economic periods, banks and investors are generally more willing to provide credit at favorable terms, increasing financing flexibility for borrowers. During economic downturns or financial crises, lenders often tighten underwriting standards, reduce available credit, and increase borrowing costs to compensate for higher perceived risk. Treasury professionals assess market liquidity, lender appetite, and investor sentiment when planning financing activities. Organizations with strong financial performance, stable cash flows, and favorable credit ratings typically maintain better access to capital markets. Understanding changes in credit availability allows Treasury teams to secure financing proactively before conditions deteriorate. Interest rates and credit spreads directly affect borrowing costs and are central considerations in long-term financing decisions. Treasury professionals evaluate benchmark interest rates, yield curve movements, inflation trends, and central bank policies when determining whether to issue fixed-rate or floating-rate debt. Rising interest rates generally increase financing costs, making long-term fixed-rate borrowing more attractive when rates are expected to continue increasing. Credit spreads represent the additional yield investors require above benchmark rates to compensate for credit risk. Organizations with weaker credit profiles typically pay wider spreads, increasing borrowing expenses. Treasury teams monitor market spreads, comparable issuances, and investor demand to optimize pricing strategies. Effective interest rate analysis supports cost-efficient financing structures and improved long-term financial planning. Loan terms and covenant structures are equally important because they influence financial flexibility, operational restrictions, and refinancing risk throughout the life of the borrowing arrangement. Treasury professionals evaluate maturities, repayment schedules, collateral requirements, call provisions, and covenant conditions when negotiating financing agreements. Longer maturities may reduce refinancing pressure but could increase total interest costs, while shorter maturities may offer lower rates but expose organizations to future refinancing risk. Financial covenants often require organizations to maintain leverage ratios, liquidity thresholds, or interest coverage levels. Treasury teams carefully assess the organization's ability to comply with these conditions under changing economic environments. Negotiating balanced financing terms supports operational flexibility while maintaining lender confidence and market credibility. Risk assessment is an essential component of evaluating market conditions because long-term borrowing exposes organizations to interest rate risk, refinancing risk, market volatility, and changing economic conditions. Treasury professionals conduct scenario analysis, stress testing, and sensitivity analysis to evaluate how adverse market developments could affect debt servicing capacity and liquidity positions. Foreign exchange risk may also be relevant when borrowing in international markets or issuing multi-currency debt instruments. Treasury teams assess the impact of economic cycles, inflationary pressures, geopolitical events, and credit market disruptions on borrowing strategies and financing costs. Effective risk management includes diversification of funding sources, staggered debt maturities, and the use of hedging instruments such as interest rate swaps. Strong risk evaluation improves financial resilience and borrowing stability. From a CTP examination perspective, candidates must understand how market conditions influence long-term borrowing decisions and capital structure strategies. Exam questions frequently assess the ability to analyze credit markets, evaluate interest rate environments, interpret yield spreads, and recommend appropriate financing structures under varying economic scenarios. Candidates should understand fixed-rate versus floating-rate borrowing considerations, refinancing risk, covenant impacts, and the relationship between credit quality and borrowing costs. Knowledge of market liquidity, economic indicators, investor behavior, and risk management techniques is also important for practical Treasury decision-making. Treasury professionals must apply market analysis skills to support sustainable financing strategies, optimize borrowing costs, and maintain organizational liquidity and financial stability in changing capital market environments.